If you've spent any time in personal finance communities online, you've probably encountered two very strong opinions about robo-advisors. Opinion 1. They're a revolutionary democratization of sophisticated investment management that puts institutional quality portfolio construction within reach of everyone. Opinion 2. They're overpriced, glorified index fund portfolios dressed up with algorithmic language to justify a fee that a competent investor could avoid entirely by just buying 3 funds themselves. Both of these opinions contain real truth. And the honest answer to whether a robo-advisor is right for you involves understanding what they actually do, what they actually charge, and what the alternative really looks like for a typical investor who doesn't spend their weekends reading financial planning blogs. My name is Nick, and I spend way too much time thinking about money, financial tools, and the realistic behavior patterns of actual people making actual investing decisions. If you want an honest assessment of whether robo-advisors are worth using, hit subscribe and give this video a thumbs up if it helps you think this through. If you've been wondering whether to use Betterment, Wealthfront, Fidelity Go, Vanguard Digital Advisor, or any other robo-platform, or if someone has told you they're a waste of money, this is the video that gives you the honest middle answer. Hit that like button. Let me explain exactly what a robo-advisor does, because the marketing language around them tends to make it sound more exotic than it is. A robo-advisor is an automated investment platform that takes your money, asks you a series of questions about your goals, time horizon, and risk tolerance, and then builds a diversified portfolio of low-cost ETFs designed to match your answers. It then manages that portfolio over time through 2 primary functions: automatic rebalancing and tax loss harvesting. Automatic rebalancing means the platform monitors your portfolio allocation and periodically buys and sells to bring it back in line with your target weights. If your target is 80% stocks and 20% bonds and stocks have grown to represent 87% of your portfolio, the rebalancer sells some stocks and buys some bonds to restore the 80-20 split. This is a genuinely useful function that many DIY investors fail to do consistently. Tax loss harvesting is more sophisticated. In a taxable account, the platform monitors your holdings for positions that have declined below their purchase price. When a position is down, the platform sells it to realize the tax loss, then immediately reinvests the proceeds in a similar, but not identical, security to avoid the IRS wash sale rule. This locks in a tax deduction that can offset gains or ordinary income, potentially saving you hundreds or thousands of dollars in taxes annually. For investors with meaningful taxable accounts, this feature alone can justify a significant portion of the advisory fee. What does all of this cost? The main robo-advisors typically charge around 0.25% of assets under management annually. Betterment charges 0.25%. Wealthfront charges 0.25%. Vanguard Digital Advisor charges roughly 0.15%. On top of this, you're paying the expense ratios of the underlying ETFs, which are typically very low, often 0.05 to 0.10%. So your total all-in cost is roughly 0.30 to 0.40% annually. Now let me compare that to the alternative. A human financial advisor typically charges 1% of assets under management annually, or charges a flat annual fee of several $1,000s for comprehensive planning. The difference between 0.25% and 1% on a $250,000 portfolio is $1,875 per year. Over 20 years, assuming the portfolio grows, the fee difference compounds to several $100,000. The robo-advisor is dramatically cheaper. If this is helping you think through your options, hit the subscribe button and share this with someone who's been weighing this decision. The honest financial comparison matters. But cost isn't the only consideration. What does the human financial advisor provide that the robo doesn't? The honest answer is behavioral coaching. The most valuable thing a good financial advisor does isn't portfolio construction or investment selection. It's stopping you from making a terrible decision in a panic. When markets crashed in March 2020, a meaningful percentage of DIY investors and robo-advisor users sold their portfolios in panic. The clients of good human financial advisors who picked up the phone and talked them through the crisis, reminded them of their long-term plan and persuaded them not to sell, those investors largely stayed invested through one of the fastest market recoveries in history. The advisor's value in that moment was entirely behavioral. The portfolio construction was largely irrelevant. Research by Vanguard's Advisor Alpha study estimated that financial advisors add roughly 3% of annual value to their clients primarily through behavioral coaching, not investment selection. If that number is anywhere close to accurate, it more than justifies the 1% fee in volatile markets. The challenge is that you don't know in advance whether your advisor will be that kind of valuable in a crisis, and the behavioral coaching is hardest to evaluate before you actually need it. So who is a robo-advisor actually good for? It's probably the best solution for people with relatively straightforward financial situations, accumulating for retirement with a simple portfolio, regular monthly contributions, no complex tax situations, no estate planning needs, no business interests. If your financial life is basically, earn money, save some, invest regularly, retire eventually, A robo-advisor at 0.25% provides an extremely functional, low-maintenance solution. Robo-advisors are probably not the right solution if your financial situation is complex. Multiple income sources, business ownership, significant estate planning needs, intricate tax situations across multiple account types, specific planning around Social Security timing, healthcare coverage and early retirement. These are the kinds of scenarios where a comprehensive human financial planner provides genuine value that an algorithm cannot replicate. There's also a third option that the robo-advisor debate sometimes obscures: do-it-yourself with index funds. If you're willing to learn basic portfolio construction, buy 3 or 4 low-cost Vanguard or Fidelity index funds in an appropriate allocation, rebalance once a year, and stay the course through market volatility, you can achieve virtually the same portfolio result as a robo-advisor at approximately 0% advisory fee. The underlying question is whether you will actually do this, whether you have the knowledge, the discipline, and most importantly the emotional resilience to not panic sell when things get ugly. For a lot of people, the robo-advisor fee is essentially behavioral insurance. You're paying 0.25% to make sure you don't go off script during the inevitable moments when going off script is the most tempting. If you know yourself well enough to know you'll stay the course on your own, skip the robo and just buy the funds. If you're not sure whether you'll make impulsive decisions during a crash, the 0.25% fee might be the best money you spend on your portfolio. If this gave you a clear framework for thinking about robo-advisors versus DIY versus human advisors, share it with someone who's been confused about this, subscribe if you're not already, and hit that like button on the way out. I'll see you in the next one.